Hello and welcome to this Association of Corporate Treasurers webinar, sponsored by Lloyds, where today we'll be discussing LIBOR transition. Arguably the most important number in finance, underpinning financial contracts worth trillions of pounds, is going away, and financial markets aren't prepared. So said Andrew Bailey earlier this summer, when he followed up his 2017 speech that effectively announced the end of LIBOR by stating that banks would no longer be compelled to submit data to the LIBOR benchmark administrator after 2021. Following Andrew Bailey's speech, and in clear demonstration of how seriously the regulators are taking benchmark transition, in September this year, the FCA and PRA sent a letter to the CEOs of the largest financial institutions requesting that they explain to the regulators their plans for transition. This has, I believe, finally focused the markets on LIBOR transition. As is often the way with developments in the financial markets, many things are outside of the Treasurer's control. Nevertheless, non-financial corporates need to understand what the transition away from LIBOR means, both for Treasury activities and for the wider organisation. After all, LIBOR is pervasive in many corporates, and also need to identify the steps needed to ensure a smooth transition for their organisation. Talking about these and supporting you in this endeavour is the purpose of this webinar. So, over the next 45 minutes, we are going to set out what's happening and why, share the latest developments and touch on some of the challenges for corporates. We would like this session to be as interactive as possible, so please submit questions as we go through, and we'll endeavour to cover off as many as we can as we go along. You'll see a button on your screen that allows you to submit the questions, so please don't wait until the end, and we won't mention your name or company, so please do feel free to ask anything. We can't guarantee, however, that we'll answer anything. Before we start, let me make some introductions. For those of you who don't know me, I'm Sarah Boyce, and I worked at the ACT here in the Policy and Technical team. And today, I'm delighted to welcome Steve Bullock, who is Head of Benchmark Submission and Supervision at Lloyds Bank. He heads up that team with primary focus on LIBOR submissions and oversight of the other benchmark activities, and has been at Lloyds for around 23 years. He's nodding. You can always tell nodding on webinar script. And is currently a member of ICE LIBOR Oversight Committee and the Sterling Riskfree Rate Term Subgroup. So he's very well positioned to be able to give us some insights as to what is happening on LIBOR transition. We're also joined by Sean Hawkins, who is Manager for Senior Funding and Covered Bonds at Lloyds. Sean is a corporate treasurer who's stepped into the banking space, who's moved to RBS Treasury and now to Lloyds Corporate Treasury in 2018, where she supports the senior funding and covered bonds issuance for the group and its operating entities. And in September this year, Lloyds issued its inaugural $750 million three-year floating bond, which is linked to Sanya. And so Sean is going to step us through that issue, which I think should be very interesting to hear about. And then, last but by no means least, Francis Hindon, who is VP Treasury Operations of Shell and is Vice Chair of the Bank of England's Risk-Free Rates Working Group, it has also joined us today. And I would like to point out that the fact that Francis is actually Vice Chair of that working group reflects just how seriously the regulators are taking the views of corporates in the process around LIBOR transition. So please don't think that we have been overlooked. We are very much in the mix and are very much engaged in this process. As VP of Treasury Operations, Francis is responsible for, I'm going to say, virtually everything that happens at Shell, particularly foreign exchange, cash management, intragroup financing, and general treasury advice. Okay, so before we start off, what I'd like to do, just briefly, is to ask a couple of poll questions. The first of which should be on your screen now. What we're trying to do is, and perhaps you could answer as I'm talking and press submit. What we're trying to do is just gauge the extent to which people have started to work on LIBOR transition. So I'll give you a couple more seconds, and then we'll just quickly click through to the results and see what's happening. Let's see what we can see. So, very pleasingly, 46% have actually started work, which is very, very slightly surprising and very pleasing, I think is the answer to that. So thank you for that. There's a second question to follow, which is just if you haven't started working on the LIBOR transition, at what point do you think that you're likely to start doing so? If you could just respond to that, that would be great. And then what we'll do is that we will have Steve walk us through actually what has happened in the LIBOR transition process to date before Sean will talk about the Sanya transaction, and then Francis will chime in with some of the challenges from a corporate perspective. As I mentioned at the beginning, we will take questions as we go through, so please do submit them as they occur to you. So equally, 46% of people have started work, and for those of you that haven't, it looks as though the next 6 to 12 months is going to be absolutely critical. So that's very interesting, and actually it sounds to me, and I'm looking around the table, as though that's more advanced than we were anticipating that a lot of people would be. So that's very helpful feedback. Thank you for that. Okay, at that point, I'd like to pass over to Steve then, who is going to take us through the story today.
Okay.
Thanks, Steve.
Thanks, Sarah. So we'll try and cover a number of topics in quite a short period of time. I think for everyone's awareness, there is a wider set of documents that will be uploaded to the website afterwards with a number of appendices in there, and there's quite a lot of helpful, useful links in there as well. There is a lot of materials out there in the market on IBOR transition. We'll keep people busy, I'm sure, for a number of days, weeks and months. But we'll try and summarise as best we can during the time we have available here. So, as just discussed, really, what was the primary catalyst for this? It was probably the Andrew Bailey speech in July of 2017 when he announced to the market that the FCA would no longer compel banks to contribute towards LIBOR beyond the end of 2021. That was then followed by a first speech in July of this year, which probably upped the ante a little bit. The rhetoric was a sense of frustration that the market really wasn't transitioning quickly enough at that point in time, and really the underlying message was any misplaced confidence that LIBOR would continue beyond 2021 should really be removed, and firms should not consider that the rate would be there beyond this point in time. And really, going back to the underlying reasons as why these speeches were made and why there is doubt on LIBOR beyond 2021, one of the problems for LIBOR certainly is and generally IBOR, what I call the typical IBOR benchmarks, is the lack of underlying transactions that are available to support the rates that are being submitted. And if we consider probably the most widely used LIBORs for 3-month sterling, 3-month dollars, they're anchored by probably around about 25% are anchored by underlying wholesale funding market transactions. I guess the best analogy I've heard really or seen is if you can picture an elephant sat on an acorn, the acorn being the underlying transactions and the elephant being the market that those transactions are essentially pricing. That's the picture that certainly probably hits home quite clearly on the underlying some of the underlying issues. So what Andrew Bailey also said in that speech is that the FCA had received agreement for all banks to continue participation in LIBOR through to the end of 2021. Contribution to a benchmark is a voluntary activity for banks. So certainly that was a positive statement that banks had agreed to contribute through until that point in time. So that kind of covers the speech. So what are the alternatives? And those alternatives are have recently been launched in some jurisdictions and in the process in others. If we turn to the UK, Sanya has been around for a number of years, but the Riskfree rate working group in the UK decided that Sanya would be the chosen risk-free rate going forward. And just for explanation of what is Sanya, Sanya is a measure of overnight funding transactions, wholesale funding transactions of £25 million and above, and it's the rate paid for those transactions. Firms will then collect that data and submit that information to the Bank of England on a daily basis. The Bank of England will then calculate what the rate is and publish it at around 9:30 the following morning. So the clear differential there between Sanya and LIBOR is that it is absolutely anchored by transactions each and every day, and it's currently off around 40 billion or so each day, so a relatively healthy number there from which that rate is anchored. In the US, risk-free rate has also been established, and that commenced in around April of this year. That's known as SOFR. That is a secured overnight funding rate. And in Europe, the chosen risk-free rate is known as ESTA, and that's set to launch by October of next year. So a little bit of different timings depending on which jurisdiction you're looking at there. So really, what are some of these challenges to transition? And you may have noted that we discussed there that the rates so far are all overnight rates, and clearly in the IBOR benchmarks, the rates published are from a variety of tenors, from overnight through to 1 year. So clearly there's a number of challenges that presents itself to, and that's something the market is currently looking at. And the creation of term rates off of some of these risk-free rates is a very live discussion right now, and we'll talk a little bit further around the progress on some of those. Other challenges, clearly that we need to avoid value transfer from counterparty A to counterparty B, and you may or may not have seen the recent ISDA consultation on IBOR fallbacks, and that's a clear aim and goal of that particular consultation as to how we avoid that value transfer. We need liquidity to build in the markets as well to allow markets to transition to these alternatives, and then we need really coordination across jurisdictions and various products as well. In terms of next steps or where we are right now, I think the message really is we're trying to raise awareness across the wider community. It's pretty well known what's happening in the financial sector, but we need to push this message out to the corporate space as well. Hence the reason we're here today. There's a number of working groups which we'll get onto later in this presentation as well, that people can become actively involved in, and there's encouragement for that to happen as well. And then really the next step, as was just discussed, what will really up the ante has been the receipt of the Dear CEO letter for the major banks and insurers here in the UK. So that was received in September. That's in the public domain. You'll very easily find that if you search for it, and we'll discuss in a little bit more detail on those Dear CEO responses, which are due back to the official sector by 14th of December. So just moving on to the next slide. I just touched a second ago on the structure of the risk-free rate working groups. As you can see, there are a number of technical subgroups that have been created, and we've had a number of these were established fairly recently. But what it's seeking to happen here is covering a number of different products and markets, and also counterparty types as well. I think one I would certainly draw your attention to is in the bottom left-hand corner, the communication and outreach group. They've recently started to publish information on IBOR transition, and we'll discuss that as well, and how you can stay in tune with that on a regular basis. It's quite a helpful forum to be kept informed of what is happening in the market right now. And then on the right-hand side, there's some specialist stakeholder forums as well. So really the ultimate objective is, for all of these, is to ensure a broad-based transition to Sanya by the end of 2021 across a number of different markets. So just going back to the Andrew Bailey speech from July of 2018, just calling out some of the key points here, as briefly discussed a few moments ago. Really, the key message here is that this is going to happen. People should not have a misplaced understanding that LIBOR will carry on in its current form beyond 2021. And also, there was an acknowledgement in the speech that there is a need for these forward-looking term rates, as just discussed a moment ago. And clearly, that's going to be the creation of those will be a catalyst for some of the transition activities that need to take place. And again, quite a strong message in here as well. The most effective way to avoid LIBOR-related risk is not to write LIBOR referencing business. That's a very clear message to the market there as well. And also, firms that the FCA supervise will need to have plans in place to mitigate the risks and to reduce dependencies on LIBOR. That was obviously followed up by the September Dear CEO letter, as just mentioned as well. And then the biggest obstacle to a smooth transition is inertia. Discussed. So clearly, this has to be on everybody's minds, and this is definitely happening over the coming months and years. But there is a view that we have a kind of a glide path, I guess, through to the end of 2021. We can have a relatively smooth transition over that period of time, but we certainly shouldn't be waiting for 2021 here before we commence those transition activities. So, just moving on to the next slide, where I briefly discussed the Term Sanya consultation earlier. So that was launched in July of this year, and it closed in October. And within that consultation, there is the firm view expressed that we believe that term rates can play an important role in facilitating transition to Sanya. Whilst we're talking about the sterling markets here, you can do a read across really to other currencies here. It's not just sterling that we'll be looking at term rates in the US. The ARC, which is the equivalent of the sterling risk-free rates working group in the US, are also looking at alternatives, including term structures, to facilitate transition. So within the Term Sanya reference rate paper, there was a number of options that were looked at, and those are identified in there. One thing, the message coming out of that consultation is it's not intended for Term Sanya to be used widely in the derivatives market. The view there is we simply don't want a LIBOR 2.0 being evolved in the market and everything just transitions to that, and we then end up with a similar issue in the future. And then the other message coming from the consultation is we would hope that the Term Sanya could be available from the second half of 2019, but clearly there's a lot to go through before we get to that point in time. So moving on to the next slide, where we talk about the Dear CEO letter that was recently received, as just discussed. So what was the ask from that, and really what are the outputs that you can expect to see coming from that going forward as a corporate? Firms are required to confirm the granularity of our LIBOR exposures, and then we need to do some scenario planning to look at what may happen if LIBOR disappeared at a certain point in time, or if there's some kind of phased transition period. And then we have to map risks across the firm and really call out what are the material risks that we have as companies on LIBOR transition and continued usage of the rate. So what will firms be doing to respond to that? There'll be a risk assessments taking place, and then a summary of those risk assessments will be included in those Dear CEO responses. Importantly, and again mentioned I think Leanne earlier, part of that letter it describes that firms need to appoint a senior manager to oversee the response to the Dear CEO and also the implementation of LIBOR transition going forward. So this also the response has to be board approved. So this is going right to the very top of organisations and really just essentially this will be the catalyst for transition activities to accelerate possibly from where they've been to date so far. So clearly a lot of work to be done by those firms, and what you can expect to see as corporates, I think you're going to see the activity pick up in terms of firms, banks, reaching out to you, looking at transition plans and how we can move ahead into some of these alternatives. Some of these yet to be launched alternatives. This part of the issue we have right now is that all of those are not there, so we simply cannot transition everything lock stock right now, but that's going to be in the phased planning over the next 2 to 3 years. So that's myself covered for now. I'm now going to hand you over to Sian, who's going to talk about some of the recent issuance in the Sanya market.
So to give an overview of the launch transaction, so on the 5th of September, on the back of a lot of hard work from various teams across the bank, including Treasury, Finance, the issuance team, obviously legal, risks, operations, we were able to price our inaugural 750 million 3-year covered bond linked to Sanya, and we were the first commercial lender to issue a bond under Sanya. The mandate was announced on Monday, the 3rd of September, with a 3-day execution recommended. So we basically spent the next 1 to 2 days speaking with investors, making sure they were comfortable with the calculation of the new interest benchmark as compounded daily Sanya. With the 5-day look-back period, we received a number of early indications of interest over those couple of days, and we felt confident enough on the Wednesday to launch the transaction at 8:30 in the morning. Final terms were released at 11 o'clock. The order book had built to over 1.2 billion, and we were able to set aside 750 million at an improved rate of Sanya, 3-month Sanya plus 43 basis points, which was 2 basis points down from where we had started in the morning. The final spread was essentially equivalent to 3 months sterling LIBOR plus 27 basis points, which represented a new issue premium for us of what was fairly flat to 2 basis points. So it was a successful morning. In terms of dealing with the accounts that didn't participate, we had feedback from a lot of people, from those that didn't, and the large majority, as you can see, didn't buy because of system limitations. We had spent some time over the 2 days speaking to investors, and some people were trying to get on board, but unfortunately there were some people that just couldn't get there in time. Some of those accounts have since been able to get involved in transactions following ours, which is good, and felt, I suppose, our transaction encouraged investors that were getting ready to prepare quickly. There was a few investors that weren't comfortable with Sanya language. There was one account that didn't like the 5-day lag, but the majority were holding back due to system limitations at the time, and that has improved since September. In terms of trades that have followed ours, we've had, I think on the following day after us, RBC came with a 1-year 350 million Sanya trade. Santander followed, I think, a week later with a 1 billion trade with terms almost identical to our own, with the same pricing. And since then, building societies, Coventry and Yorkshire have also followed with 2 500 billion 5-year covered bond trades, 3 months Sanya plus 60. And touching on the US equivalent, the SOFA transactions, their space has definitely, it's been a very quick transition for them. They have built that market very rapidly, and we've seen a number of trades in the SOFA market since July. These trades are generally shorter tenors, somewhere between 6 and 18 months. We've seen issuances from Fannie Mae, Credit Suisse, JP Morgan, Wells Fargo, and MetLife, to name but a few.
Can I just ask you a question quickly as it's coming in? It's relevant to what you're talking to. Somebody has asked what the 5-day lag in the Lloyd transaction related to?
Yeah, well, I'm actually going to touch on it. Okay, fabulous. That'll be on. So this slide looks essentially at the differences between Sanya and SOFR and what we're seeing at the moment. So in terms of compounding and averaging, so in the Sanya market, the bond and swap use a compounded rate throughout the interest period. SOFR typically uses, they have compounding interest in the swap interest period and a daily averaging. It's a very simple average of daily rates which they're using. In terms of the look-back periods, so essentially when you're calculating your bond and your swap coupon, with regards to the 5-day look-back, your reference period for for the interest period is essentially 5 days behind. So you're always looking 5 days behind for your daily interest rate. So that's what I mean by 5-day look-back. With regards to SOFR trades, they don't use a look-back period. They use a lockout period, which all sounds very confusing, but it's essentially you're using the last 2 days of your interest period are held fixed in order, and both of them are essentially to do the same thing, and it's essentially to avoid volatility and give, I suppose, the paying agent comfort that they can calculate the final interest rate applicable to you in time. And I think, so, and Steve will touch on it, but the development of term rates will make this a bit easier. Essentially, the idea is, or the hope is that Sanya and SOFR rates will eventually converge, and we will have one market standard rather than many different standards. EIB actually recently, I think last week, came with a 3-year US dollar SOFR trade that has, rather than using a daily averaging rate as many of the Sanya trades have done, SOFR trades have done, sorry, they went for compounding, but interestingly also had a lockout period at the end. So I feel like we're perhaps getting somewhere. It's just taking a bit of time. And I think the only thing else I sort of really want to point out on this slide is just around the investor universe. And for Sanya, there's now around 100 plus investors out there that are willing to invest, specifically for us. For SOFR, we're looking at slightly short of that number at just around 60 plus, but that number is growing all the time.
Thank you, Sean. So Steve, shall we touch on some of the challenges?
Yes, we can try. We tried to list a number of them. I don't think we've covered all of them here, but certainly hopefully we've captured some of the main challenges that the market needs to face here, when it needs to overcome. Clearly, the sheer scale of this transition activity is huge. LIBOR is embedded across a number of financial sectors, ranging from your small corporate user or retail users, actually in some jurisdictions, right through to your largest financial institution and global corporates. So it touches a number of different areas across the markets, and the transition will have to be carefully managed for that. The timing, as things currently stand, we have the potential cliff edge effect of January 2022 of LIBOR cessation. So clearly the clock is ticking, and if you think we're already close to a year and a half past the original Andrew Bailey speech, so time is moving pretty quickly on that. Pace of transition is differing across different jurisdictions, and that's going to be a bit of a challenge for the market going forward. I touched on where we are in terms of the risk-free rate publications. The European risk-free rates is not even being published as of now. The expectation is that is by October of next year. So clearly that's something else that needs to evolve pretty quickly. And then there's also the operational challenges as well that every firm will have to overcome. If you consider, you're used to receiving or fixing something off of a 3-month LIBOR fixing, and now potentially you're using an overnight daily compounding rate, that in itself brings in a number of challenges for users as well. Huge budgets running into hundreds of millions of dollars for some firms as well, that some of the major global banks will be facing. So that's just another point to add. We also need the building blocks to be in place within the market. So we need some of these term structures. We need the products. We need liquidity in the markets, and we also need market infrastructure as well. And all those discussions are going on right now. And then some specifics in the loan markets. As we discussed, we have these risk-free rates. They're all overnight right now. Corporate treasurers clearly made the signal, the messaging that they desire term structure, so a forward term looking structure for cash management purposes. So that is something that needs to evolve across a number of different currencies. Practical issues in syndicated loan markets as well. You can imagine a facility with scores of banks in the same facility. That itself presents practical challenges if you were imagining that facility was referencing a compounding Sanya rate each and every day. And then existing contracts as well, the agreement to transition existing contracts to some of these alternatives. Bond markets have some unique challenges as well. I think the one point I would make in there is that in its worst case, and Sean perhaps can correct me here, is in the worst case scenario, if you have a floating rate bond, the fallback provision is you look back to the last published LIBOR rate. What does that mean? You thought you had a floating rate bond, you now have a fixed rate bond, and depending on the way the yield curve is working at that time, you may be happy or unhappy about that particular outcome. So clearly there's work to be done in that space. Derivatives, whilst it's absolutely the lion's share of the LIBOR referencing market in volume terms, it's possibly the simplest for transition, and the fallback consultation that we discussed earlier will assist with that transition activity. As they announced the results of that, they made an initial publication within the last couple of weeks on how those adjustments are going to look like, and just by way of background, why are adjustments required? If you have a derivative contract at the moment where you're receiving LIBOR at present, and then, for example, that turns into you will be receiving Sanya, as described earlier. Clearly, Sanya is just an overnight rate. There is no credit component in that, so therefore you would want some kind of compensation for the fact that you used to receive LIBOR and now you're going to receive a lower rate, such as Sanya. And then that consultation, there'll be a further announcement on that by the end of this year, when they're expected to announce what that fallback will actually look like. In terms of, we touched on the retail use. I think here in the UK, it's probably quite small in the retail market in terms of LIBOR usage, but certainly across other jurisdictions, it is much more widely used. And then the other thing, another quite a problem. We're all aware in contracts we have these fallback arrangements in current documentation, but they were really only ever designed for temporary cessation, so that's if the rate wasn't available for a day or two. They never really envisaged permanent cessation, so that again is a particular challenge that we need to overcome in the transition activities.
Okay. Thank you, Steve. Francis, turning to you, that's been a very thorough overview of what's been going on in the world of LIBOR. From a corporate perspective specifically, what are your main challenges and issues that you're encountering at the moment?
I think one of the interesting things about the way this is developing is that it started off, if you like, with derivatives traders saying this doesn't work. And all the initial work was done through banking institutions, initially derivatives, and then it widened. Whereas when I look at where our exposure to LIBOR is, if I take Shell as an example, it's true we have exposure in the loan markets, the bond markets and derivatives, but actually the most amount of work we're going to have to do sort of spreads out from that into areas that some of our partner banks don't necessarily see. So if I start in Treasury and move outwards, some things we have to think about are, well, relating to the loans and the derivatives, there is hedge accounting. We're not having a webinar on hedge accounting. I'm not sure we get quite so many people signed up if we did. But there are some quite nasty consequences of the cessation of LIBOR, possibly for your hedge accounting and your hedge accounting documentation. So there's a lot of work actively going on now within the working groups and certainly at the IASB on what the consequences are. We have all our intergroup funding is LIBOR linked. Now that's not an economic exposure, but it is a transfer pricing exposure, and there is a lot of documentation that needs updating, a lot of discussing with the authorities that needs doing. All our current accounts are LIBOR based. Our mark-to-market valuations come off a LIBOR curve. I learned about this on Wikipedia because Wikipedia is in fact the source of all knowledge. That historically lots of people valued their swaps using LIBOR curves, but most banks nowadays don't. They have far more sophisticated models. However, most corporates do not have sophisticated models, and I think we're hardly unusual in doing all our valuations off LIBOR. So we have big systems updates we're going to need to do. We benchmark things like pension fund performance against LIBOR. And moving slightly away from Treasury, I think this is one of the challenges, that it tends to be treasurers who are looking at this. We have a number of floating rate leases around the group that are LIBOR linked. We have project finance, which is LIBOR linked. And one of the questions that came in was people who do structured financings quite often are required to hedge floating rate exposure, which then leaves a bit of an issue that if you have floating rate exposure on one side that's LIBOR linked, how do you then hedge that to a fixed rate until when we don't yet have, we might have the derivatives there, but we can't necessarily hedge account for them. And then moving away from Treasury, plenty of commercial contracts might have escalation clauses, they might have penalty payment clauses, and real estate might have rental escalation clauses based on LIBOR. One of the challenges that someone gave me the other day is that they have a rent escalation clause which is floored at 0. So if interest rates go negative, it can't go negative. But of course, the LIBOR floor at 0 is not the same as a risk-free rate floored at 0. So risk-free rates might be negative if LIBOR was 0. How does that affect the economic value of the contract? So there's a lot outside the financial markets world that corporates depend on. I mean, one of the consultants who said to me last week, actually the real challenge is around intergroup funding, particularly for large multinationals. It's cross-currency, it's cross-jurisdiction, it needs discussion with a number of different, perhaps, fiscal authorities. A lot of work to do there. And one of the challenges, and I know Sarah's going to come to this, that we sort of come up, and there's another question on this, which is, what are you supposed to do when the products you want to use don't exist yet? So I saw one question about what happens if you want to renegotiate your RCF, what happens if you want to issue a new bond. Unfortunately, right now, particularly if you're US dollar dependent, because SOFR has got a very short history, unlike Sanya, which has been quoted for a long time, can't say you can just go out and issue SOFR linked or Sanya linked or negotiate a new RCF today, because many people's systems aren't ready for it. Oh, Steve's shaking his head at me. It's not a good webinar thing to do. What you can do is what we did, for example, when we recently issued a new floating rate note, is you put language in, at least now, that acknowledges this is going to happen. So the Loan Market Association and the ACT have published suggested clauses for loan documentation. There are going to be some papers published from the Riskfree Rates Working Group talking about clauses in bond documentation. A lot of it is being ready for what's going to happen. So even if you can't issue now, you might know that there is something coming up where you get the documentation in, you get the clause in now, and at least you're ready for it, and you have to go back and start asking for 100% lender consent.
Just picking up on one of the points that you made there, Francis, you talk about, it's in relation to intercompany, but actually it applies to a lot of things, about the cross-jurisdiction element of all of this. What is your, this is probably with your working group hat on rather than your shell hat for a moment, but what's your experience of the international coordination efforts around this? Because obviously for a lot of people, you know, we have cross-currency swaps, for example. How's that even going to work? She says naively.
So I mean, one thing to remember is that there's already difference in market conventions across currencies. You know, GBP LIBOR quite often quotes on a different day count basis to US dollar LIBOR. We can cope with things not being the same. It would be lovely if everybody ended up with the same transactions, same conventions. It probably isn't going to happen. To answer your question, there's quite a lot of cross-jurisdictional communication going on. So there is an international, it's run by the US dollar, the ARC, the Alternative Rates Committee. They have a working group on cross-currency swaps, which I dial into occasionally. nearly as exciting as hedge accounting.
On which somebody has actually requested a webinar on hedge accounting, so be careful what you wish for, because you'll be back.
I'm not the expert. I can really talk about it.
Sorry.
So there is a cross-currency swaps working group looking at trying to get consistent conventions globally. It's currently working on dealer-to-dealer swaps. Dealer-to-end user, as we're slightly known, will come later. There are regular calls, conversations, meetings between all the central bank, the market-led working groups, also run by the Fed at the moment. So there's a lot of communication. I would say coordination is a little harder because everybody wants there to be common conventions, common market approaches, as long as it's the one that we want. This reminded me of the long ago desire to converge US and IFRS accounting standards, which everyone thought was a terribly good idea and fell to pieces because the US said it had to go our way and the IFRS said it had to go their way. So communication, yes. Coordination, more to be done. Okay. We're definitely all talking to each other.
Okay. Well, that's helpful to understand. I'm afraid that we are rapidly running out of time. This is clearly a subject that we need to do regularly. So just to wrap up with, can I ask each of you what one, two, three things you think corporates should be doing now or come January, because let's face it, it's almost Christmas now.
I mean, for me, it was very encouraging the survey results where people either have started or they're about to in the new year. I think we've got 77% of people covered there, so that was helpful. If you haven't started, the simple thing to do is do a stock take. What is your LIBOR inventory looking like? What have you got pre-21? What have you got post-2021? And what new transactions are you looking at over the coming weeks and months? And also do an inventory of your systems as well, and any EUCs that you might have that have a reliance on LIBOR, and is there any transition activities that will need to take place in any of those? I think those will probably be my two kind of front book pieces of work to do.
Sean, have you got anything to add to that?
I would say systems are very important, and just speaking to people internally, operations, legal teams, trying to understand capabilities.
Okay. Francis, anything you'd like to add?
I'll put my working group hat on, and I'll echo what Steve and Sean said about looking at what you've got, and particularly systems. From my working group hat, there is a monthly newsletter that Steve mentioned earlier. Sign up to that. It's only one page. You can either email the Bank of England, the Riskfree Rates Working Group, or the ACT very generously said they're happy to pass on your details. There is also, within the UK, we do run a corporate forum. We were a bit nervous about offering this to everybody who might be interested in case thousands of people came, but it's not. We meet about every couple of months and just talk about current issues, what's happening, trying to get input from people. So if you are interested in taking a more active role in understanding what's happening, again, contact the ACT or the Bank of England and they will give you more information.
Okay, thank you very much indeed. I think that we've pretty much run out of time now, so I hope that you found this very quick canter through LIBOR transition helpful, and we've provided you with some things to consider, given the fact that this transition is actually pretty much inevitable and will happen. In addition to the materials that people have mentioned as we've been talking, many of those are going to be available on the links to the recording of the webinar that we'll forward to you in the next couple of days. But please also do talk to your banks, look at the ACT LIBOR webpage, which we keep updated. Feel free to contact us directly with any questions that you may have, and we'll try and either answer them or point you to the right person. Contact details will be uploaded with the webinar, as I've mentioned. Thank you very much indeed for all of the questions. Very high number of participants, and we haven't been able to answer everybody's directly, but we will be producing an FAQs document in relation to this, which should hopefully address many of these questions that we didn't get to today. So in summary, I hope that you found everything helpful today. Please could you take the time to fill in the survey, as the feedback that you provide is very helpful to us when arranging future events. we will bear in mind the numerous now requests for a hedge accounting webinar. But finally, I'd like to thank Steve, Sian and Francis and Lloyds Bank sponsors. So from all of us, Merry Christmas and goodbye.